A company purchased a machine for rupees 5 lakh on 1st January 2006. It is to be depreciated at 10% per annum on diminishing balance method. Now diminishing balance method implies written down value method. So in this case 10% depreciation would be charged on the book value every year. Then the accounts are closed on 31st December each year. That means the financial year runs from 1st January to 31st December. You are required to show machinery account and provision for depreciation account till 31st/12/2007. Now students, we have purchased this machinery on 1st January 2006. So on 1st January 2006 the entry would be to bank account in the machinery account for rupees 5 lakhs. Now since in this case we are preparing provision for depreciation account, so the depreciation of 10% on 5 lakh, that is 50,000 for first year, would be charged to provision for depreciation account, as the journal entry in this case is depreciation to provision. So on 31st/12/2006 it is by depreciation, amount is 10% of 5 lakh, that is 50,000. Since this is the last date of the year, let us balance out both the accounts. 50,000 here on the credit side, that is the total, and the balance would be 50,000 as there is nothing on the debit side. 31/12/2006 to balance carried down 50 and the total is 50 on both the sides. The same thing would be for machinery account. The total is 5 lakh here. At the end of the year 31/12/2006 it is by balance carried down 5 lakh and the total is same. Now we have a closing balance in machinery account and provision for depreciation account. This would be brought down as opening balance in year 2007. So on 1st January 2007, to balance brought down 5 lakh in the machinery account and 50,000 in provision for depreciation account. But the date would be 1st January. By balance brought down 50,000 here. In year 2007, there is no other entry besides purchase or besides depreciation. There is no purchase, no sale. So at the end of this year, that is 31/12/2007, by depreciation, again let us look at the method. It is diminishing balance method. So depreciation would be charged on book value. So how do we calculate book value? In this case 5 lakh was the value of machine. Until date 50,000 has been charged as depreciation. So the book value is 5 lakh minus 50,000, that is 4 lakh 50,000. So 10% depreciation would be charged on 4 lakh 50,000, which in this case comes to 45,000. I'll just mention here 10% on 4 lakh 50,000. How come we have calculated 4 lakh 50,000? 5 lakh was the cost minus 50,000 depreciation till date, that is 4 lakh 50,000, and since it is written down value method, so 10% of 4 lakh 50,000 comes to 45,000. Again this is the last date of the year. Let us find the closing balances. 31/12/2007, the balance of the machinery account comes to 5 lakh only. For provision for depreciation account, the total is 95,000 on the credit side. So the balance at the end of the year would be to balance carried down 95,000, and these balances can be brought down on the first date of the next year, and if required the accounts can be carried forward.